Lots of so-called gurus are calling for a stock market crash, and in this video I'm gonna show you 3 data-driven factors that you must know, because when this change, oh boy. Welcome back, it's Marco here, and the very first factor is the Fed balance sheet. And this is a chart of the Fed balance sheet versus the S&P 500. The simplest way to describe the Fed balance sheet is basically the amount of money that the Fed is printing. And if you look at recent years, so basically 2019, 2020 and 2021, so at the time of recording, the balance sheet has been going up and up, and that is also with the market. So when the balance sheet goes up, the market follows along, and the Fed balance sheet is the first of the 3 factors we are gonna have a look in this video. And in just 1 second I'm gonna show you how important is this balance sheet for the stock market. But just remember that I make new videos like this one on a regular basis so that you know what to do with your investments. Now, this is not the first time that we see something like this. Now we are looking at 2013 and 2015, the balance sheet going higher and the stock market following along. What's really interesting, and you really have to pay attention now, is that when the Fed changed the policy, and so you see that the balance sheet actually stayed steady for a few years, that's when we have this yellow square, and we see that even the stock market is actually trading sideways. We're actually going a bit sideways, then dropping, then going back up, but mostly it is a sideways kind of action. Now, what's really interesting, and you absolutely need to understand, is that this sideways action did not last for the entire time, where the balance sheet was actually staying steady and not growing. In fact, few years later, as you can see from this other green square, the balance sheet stayed steady, but the market overall grew and actually hit an all-time high for the time in 2018. And when the policy changed again, as you can see in this red rectangle, the Fed tried to reduce the number of assets on their balance sheet, the stock market actually crashed. You see the red line is going down, and this is the balance sheet, and the stock market is the blue one, and it's going down and crashing. And so that is evidence that every time the Fed changes their balance sheet policy, the stock market follows along, from a bear market into a bull market, and vice versa, also into a kangaroo market going sideways for a few years. However, there is another factor that is very important, and we're gonna have a look at now, which is stock valuations. And I know what you're thinking now. What is everyone talking about is the Buffett indicator, for example, that is on the screen right now, but there is also another one, which is the PE ratio, and there is another reason, another topic that is used by most gurus to say that we are overvalued and we are about to crash. But we cannot just look at stock valuations on their own, because money can flow into multiple assets. So along with stocks, we have bonds, we have commodities, and now we have cryptocurrencies. And I'm gonna give you a hint about the future, but at the time of recording, both crypto and commodities are not too big of an attraction for hedge funds and banks compared to stocks and bonds. These are the big players. These are the 2 big assets that are fighting off each other, and we're gonna have a look at just now. In fact, you cannot just look at the Buffett indicator on its own. We also have to look at treasury bond rates. And so, for example, when we had the internet bubble back in 2000, investors, and so as I told you, banks and hedge funds, they had a better option when investing in bonds, because the bond yield was much higher, with an average at about 6% back then. These days it's much lower, and it is growing, I know, but it's much lower, making it a much less interesting asset for big money. And this is, by the way, what you're seeing on the screen right now. Despite that, in 2021, at the time of recording, we have seen a very interesting change of direction, which is completely different from 2020 and 2019. And this is what you have on the screen right now. This is the money flowing into bonds and equity, and as you can see, there is way more money going into bonds versus equity. This data comes from the Investment Company Institute, and this is exactly the same data that I downloaded from their website because I wanted to check for myself. And as you can see, it is true that stock ETFs are attracting way less money than, for example, bonds. But what's really interesting, and as you can see, I've actually highlighted in red when the money is flowing out of an asset versus versus when the money is going into an asset. So bond, we have it in this row, and then we have equity on this other row. And what's really interesting is that in 2020, stock ETFs were actually in a worse position than they were today. Same thing applies to 2019, with actually a lot of money going out of stock ETFs compared to bond. But that doesn't make sense because 2020 was actually a great year for stocks, right? Which takes me to the second takeaway factor of this video, which is that in 2020, money went into single stocks versus 2021, where money is going into stock ETFs. And because stock ETFs actually cover the vast majority of the American stock market, that is why, for example, at the time of recording, we see that the whole market is green and is going up a lot, versus some other days where the whole market is red and goes down all at the same time. And going back to the flow data, which I highly recommend you to go and have a look for yourself, but look at the estimated weekly fund flows. It's very interesting because it tells you how smart money, so hedge funds and banks, are actually investing in the stock market. So for example, 1 week they plug a lot of money into the market, and as you can see, we are positive. The week after is totally negative. As you can see, the money is leaving. The week after is up. The week after again is down. So up and down, up and down. But there is also a third factor that can cause a market crash that I'm gonna show you in just 1 second. Just if you're enjoying this video, tap the like button so that you help me spread knowledge on the stock market so that people don't get caught out. And the third factor is margin debt, also called leverage. And so it's been going higher and higher since 2009 till today, 2021, with the exception of 2018. And guess what happened in 2018? And this beautiful article from December 27, 2018 says it all. The Federal Reserve raised interest rate 4 times this year, 2018. And what's really funny is that who did it was actually Chairman Jerome Powell. Look at him, 2 years younger and still messing up with the stock market. And what's really good is that we have now come full circle. And in fact, we're back on the Fed balance sheet versus S&P 500. So after an initial drop because they increased the interest rate in 2018, again, red square, the Fed did a full 180. So they dropped the interest rates, and on top of that, they also increased the Fed balance sheet, leading to the bull run we are currently on and we are still enjoying at the time of recording, and that I told you at the beginning of the video. And if you enjoyed this video, you will love the video that is on the screen right now. Click on the video and I'll see you there.